An aggressive rate hike of 50 basis point or 0.5% by the Reserve Bank has left the stock markets breathless and corporates stunned. The verdict out there is the central bank is more worried today about bringing prices down and cooling inflation than it is about growth in the economy. A month ago, I had spoken about this possible move and how it would lead to a period of demand adjustment. Corporates will have to bear the pain of expensive capital. Companies will have to make products and services more reasonable. You and I will have to postpone our purchases. So, to keep demand intact, margins will be hit and stock prices will reflect this. What am I saying? I'm saying get ready for some amount of pain, which has already started this week in equity markets. We'll discuss a little bit more today on the impact of a rate hike with my panel, Harsh Rungta, CEO of Apnapaisa.com, and Sanjeev Bajaj, MD Bajaj Capital. Gentlemen, thanks so much for being here. Harsh, you're the expert, so let me start. The impact hasn't come in yet, but this 0.5% is going to take home loan rates up to 11%. What's going on? What should a person do?
Clearly, there is no way that the interest rates won't go up. Current indications and the underlying language that is being used clearly show that this is not the end of interest rate hikes. We may see a little more. So clearly, I think belt tightening times for consumers. Clearly, I would say three things clearly you need to do. First, you can't afford to pay more than what the lender is charging to its new customers. And if you are lazy, I think you should just stop cribbing about inflation, because this just requires for you to compare what rates are available in the market and shift. If you've been a good customer, you can actually save a lot of money. There are lots of consumers who are on floating rates who are paying 12%, 13% today. There is no earthly reason why they should be paying that despite the rate hikes. I mean, if you're paying more than 11, you're paying way too much. So shift your bank if it is charging you more than 11, and of course assuming you are a good customer. Secondly, I think given the inflationary times, you cannot afford for your investments to lie in what I would say non-maximized manner. So I think you need to review your investments. You can't put them away in areas such as, say, traditional life insurance policies, which give you very, very minimal returns. And the third, look at creative ways of saving expenditure. I mean, out here in Bombay, if you live in the suburbs, you can actually change your electricity supplier. I have done that. That saves me close to 2,000 rupees a month. I mean, sure, it took a little bit of effort, but you now, in the given time, if we don't do that, it really is going to be tough times.
In fact, economists have really looked into the statistics and data and saying, you know what, we're actually getting used to inflation, and that's the big worry that the central bank also has. Prices are rising and we are getting used to those prices. We don't think that things are very expensive anymore. Prices really hurt the people at the bottom of the pyramid or much lower down in the pyramid. What do you and I do? We just cut down on our savings. Our first caller, let's bring him in. He's an overseas caller. Sir, go ahead. What's your question?
Hi Manisha, this is Biswajit. I'm 32 years old. I'm calling from Canada.
Okay.
So my plan is like I have like FDs in India, like for 14 lakhs, and current rate is like I have done this booking on a 9.5% rate.
Okay.
So currently rate are higher than that. So should I break this one and book a new FD? I know that there are penalties are involved in that. So that's my question one. My question two is like I'll return back to India after 1 year, and I am having a plan to buy a flat, cost around 40 lakhs. Okay. So for that purpose, I have a handsome savings over here in Canada. I want to do. So what is the best way to send my money back to India and save it there? Like, is it FD or some other stuff? Regarding my current savings, I have some mutual funds in India as well. Like my current mutual funds are like HDFC Equity, HDFC Top 200.
Right. You do have your portfolio.
DSP BlackRock, small and medium cap.
Okay.
And Reliance Vision Fund. So my monthly savings are around 15,000 per month in these mutual funds, and I am saving these for last 4 years. Apart from that, I have health insurance from my company. For me and my wife, each covering 3 lakhs. And I have a term insurance from LIC Jeevan Amulya 1, which covers around 40 lakhs, and I'm paying 17,000 per annum, the premium, which I think is a bit high comparing the other players available in the market. They are offering very cheap policies. So my another question is like, should I go with this LIC one, or should I opt for some other policies which are cheaper than that, with the same cover is 40 lakhs?
All right, that's a very long question, Biswajit, but we'll kick off this discussion and the answer with your first question. Your fixed deposit booked at 9.5%, and you already see that banks are giving higher rates for long-term deposits. Harsh, that's another problem of a rising interest rate scenario. You may just have booked an FD and you start feeling cheated again, all over again, saying, oh my God, I could have done better. I heard that from my own father. He said, I booked it at 10.5, and now after the RBI announcement, maybe banks will offer better rates than that. So what does one do?
Well, I think in Biswajit's specific case, his need is just 1 year away. I mean, he's going to utilize these fixed deposits and the additional savings that he's planning to make every month to make the down payment on the house and preferably to buy it outright. I think that really is what he wants to do, in which case he can't really move away from debt. So whatever existing fixed deposit, 9.5 will still a little bit low. We will see slightly better rates come up soon, but not too far away. If he breaks it now, remember, he'll only get paid, he won't get paid 9.5 minus penalty. He'll get paid the period for which the fixed deposit was held with the bank minus penalty. And that interest rate for the period will be determined on the date on which he made the fixed deposit. So I don't think for a 1 year period it will make sense for him to break his current fixed deposit. The existing savings he should again make in either a recurring deposit or a ultra short term fund or a fixed maturity plan, considering that he will need it in just 1 year. I think the other question was, he had a lot of mutual funds. Again, a lot of them are, I think almost every one of them are equity. If he intends to use that money for his house, then it is about time that he starts shifting out of equity into fixed income, even for that, because otherwise the risk is a little too great for the time period that is left.
Biswajit, I would absolutely agree with Harsh's recommendation there. We don't recommend equities or going heavy in equities if your goal or the money that you require is not too far away. So 2 years is all that you have to accumulate a down payment for your house. So start moving the equity money to balanced funds or even debt funds. Go absolutely safe. Fixed deposit, continue with it. Sanjeev, LIC Amulya Jeevan term policy, is it the best one to be with, or he could do better on that?
See, the term rates have come down very drastically. So obviously, and term plan is one plan where you have no loss if you shift. So today, if he buys a new policy, you know, I'll give him indicative rates. For a 50 lakh rupees, he may have to pay about 8,000-9,000 rupees for a 50 lakh cover on a term without return of premium, and about a 15 to 16,000 on a new generation top plans, or about maximum 17,000 rupees. So I would definitely recommend him to shift to a newer plans, and I would recommend that either he should go for a term without return of premium, but I personally prefer a new category of plans which are called new generation trop plans, because they have certain advantages. One, that most likely people will survive. So they return all the premium paid, and also they come up with a unique feature called no lapse guarantee, that after 3 years, in case a person stops paying the premium for any reason, he will still get the proportionate sum insured and he will get his money back.
Wow.
See what happens with term.
That's a lot of innovation in insurance that you're talking about. It's all because of competition, right, Sanjeev?
That is true, and also what happens with trop is that, you know, people generally, something happens to them, if they go in for a critical illness, a lot of times people actually forget to pay their premium when they're undergoing the treatment. And a lot of times term plans doesn't cover the risk what they were bought for. So now companies have realized that a lot of people lose their cover because they forget to pay the premium if they get sick or they have a critical illness. So, you know, these new generation plans where at least you get the proportionate sum insured, even if you forget or you're not able to pay the premium, the part of the risk cover continues. Now these are the new generation plans which have started coming out, and I think they are much better for the investor.
And do you have some names in mind?
Yeah,
Sanjeev,
one
that
of
you can recommend?
the cheapest plans in this category is an Aviva Life Shield Advantage.
Okay.
There the premium for 50 lakhs would be in the same about 15 to 17,000 rupees. The difference would be that he will get that 17,000 rupees back on maturity. Plus after 3 years, if he stops paying the premium, he will still get the proportionate sum insured, 50 lakhs divided by the term he bought it for into the year's premium paid. Plus he will get all the premiums he had paid back at when he is 65. So there is a lot of advantages, and there are a lot of other companies who have filed these products and they are coming out with it. So I think Aviva has started, and another few companies will be available in this category in the next couple of months. These are very exciting plans, and I think that's the way to go.
All right, so stay put with your FD. There aren't too many fixed deposits which are offering you much higher rates than what you're getting currently, but do switch your term plan is the verdict here for you, Biswajit. We've got Rajat Parmar joining us next from Mumbai. Rajat has a slightly long question. I think between two questions we might just wrap up Let's Talk Money today, but go ahead, Rajat. What would you like to know?
I have a couple of questions for you. I'll just run through my portfolio. I've already mailed you my details. I have a term insurance worth 50 lakhs, Religare term insurance, and I have a LIC Jeevan Saral which has started in July 2011, term of 30 years, and I'm paying a premium of 85,000 per annum. I wanted to know if it's a good policy to invest in, because I've seen your past shows and you've not spoken much about LIC policies. So I just wanted to know how good is this policy. And I have recently started mutual funds from this month, in fact, and I have HDFC Top 200 and IDFC Premier Equity. My aim is to build a corpus of about 4 crores. I just wanted to know if I'm on the right track, and if I need to invest more, please guide me, where do I need to invest in. And I wanted to invest in a couple of more mutual funds to diversify my portfolio, but my agent told me that you should probably wait till the month end and also till the time market comes down. So I think that's a good advice, but I wanted to take a second opinion on that. So please tell me if I should just start the mutual funds, or I should wait till the market comes down for the other two funds which I'm trying to invest in.
Okay, here's a long list of questions. But Rajat, what stands out? You're just 27 and you're aiming big, 4 crores. So no small ambitions for you. When will I become a crorepati? That's not your question. You want to go straight to 4 crores and you haven't said by when. So I'm assuming the sooner the better. And the best part is when young people ask us these questions, it's easier to get them to the right path and get them to build some amount of serious wealth in a short period of time. Okay, let's start with that first big question. Agent saying, wait out, there's pain in the market. I think I must meet your agent. I do think that there is pain in the market. But Harsh, I mean, who can time the market? We can't. And unless he's thinking of a lump sum investment, he really doesn't need to time the market or wait for that perfect opportunity or hitting this or getting that bottom in this year.
Oh, absolutely. I think the beauty of a systematic investment plan is the fact that you don't have to bother about timing the market. Really, you're not making a lump sum investment. You're making a long-term commitment through a systematic investment plan that will iron out all such timing. So, as you mentioned, the earlier you start, the better off you are. So don't wait. When you're doing a systematic investment plan, please don't wait. Please don't use timing. Choose good funds. If at all you are a reasonably active investor, use your activity to review the investments that you are making rather than trying to time the market. Even in mutual funds. Mutual funds are not shares. I mean, when you do a systematic investment plan, you are already spreading your risks through market ups and downs. So I think the choice of his funds is pretty good, except that of course is very 2/3 of the investment that he is making is in mid and small cap fund, a good fund, but still he will need to make much more to reach the target of 4 crores. I think depending on how much he can save, he should definitely increase the amount that he can save every month and look at large cap funds. He already has an exposure on SIP to IDFC Premier Equity. He should increase his exposure to large caps or diversified funds.
Okay, so 27, 4 crores is the target. Go aggressive on equities and maybe gold. We will discuss. I mean, gold returns have been fabulous, so include that in your portfolio. Sanjeev, quick advice on his insurance. He's got a reasonably good insurance for 27. I'm surprised. 50 lakh cover, fantastic. And LIC Jeevan Saral.
See, I think Religare term is one of the cheapest in the market, and you have gone for the top. I have already explained in the last question, you have an TWRP without return of premium, what you have chosen, or you can choose a term with return of premium, which I think is preferable. You know, I personally prefer those products. But on the Jeevan Saral, see, Jeevan Saral, you have to understand, it's a very, very simple, but it is a very pure debt policy that you have bought. So, you know, this 85,000 rupees you are paying in, you have to put it like that, this is my debt portfolio, I put this money in my bank. So, you know, you can compare it like a bank FD. You know, so bank FD will give you on average 8% return if the returns remain the same over a long period of time, and less tax, you will be left with about 6%, and that's the kind of return, 5 to 6%, I think best case scenario you can expect from Jeevan Saral. So it's a very simple plan, but it's not, you know, so you can be sure that if you're paying 85,000 rupees a year, you will end up investing about 25.5 lakhs, which will grow to 35 to 40 lakhs in the next 30 years.
He's not going to make 4 crores this way.
Not on Jeevan Saral, but again, you have to have a diversified portfolio, and you need debt as a part of that. A lot of people for us think that for retirement, only equity is the only way, and last 3 years, 4 years, we have seen equity has been very volatile and has been pretty flat. So, you know, so point is that yes, you need to have debt in your portfolio. So if you're going to continue with this plan, don't invest in debt further. If you want to reach your goal of 4 crores, then your future investments would have to be in products like gold, or, you know, which are like somewhere today between debt and equity, or you'll need to go for pure equity funds, and you'll have to invest in them, remain invested in them for the long run to be able to reach your goal.
So there you go. Debt has its uses, but going over on debt may not be the best way for you, Rajat, to reach your 4 crore target. I've got Dinesh, 38 years of age, joining us as the next caller from Kollam, Kerala. Dinesh, go ahead. You've got 2 ULIP policies. Let's figure out what to do with them.
Hi, Manisha. How are you?
I'm good. How are you?
Yeah, fine. Thanks. Congratulations for having such a wonderful show.
Oh, thanks, Dinesh. Thanks for the compliment. But hope we can help you. Go ahead with your query.
See, I already written my mail that I'm into 2 ULIPs, one from HDFC and one from MetLife.
Okay.
And HDFC have already paid my 5 premiums. That premium is 50,000 each per year. It's an annual premium.
Okay.
And MetLife I have paid the same amount. It's also an annual premium. Now, my question to you is, as far as HDFC is concerned, I'm hardly getting any returns. It's into negative now. But as far as MetLife is concerned, I'm having a marginal benefit out of that.
Right.
So should I continue paying my premium from next year onwards?
Okay.
And not only that, with these 2 premiums, I'm taking care of that my 1 lakh IT bracket also.
All right. So he is getting tax benefits. Sanjeev, you have a pertinent question to ask as well. Why did he buy those ULIPs, right?
Yeah. So Dinesh, I would like to understand, who have you bought these ULIPs for? What was the basic purpose of buying these ULIPs?
Actually, at that point, it was quite low at that point, and not only that, I had a common friend working in these 2 organizations. So through them only I got into these 2 ULIPs.
So let me just explain to you. See, point is that whether ULIP is good or bad depends on what purpose have you bought it for. Like if you have bought the HDFC Youngstar Suvidha for your child, then you know, then it is carrying a very beautiful feature called waiver of premium. So that means that in case something happens, future investments would be made for the child, so that child should get that investment. But one, if you are buying it for your child, 10 year is too short a term. You should have actually opted for a longer term. If you exit now, this is a plan where all the charges are upfronted in the first year. I think and the first year charges are in the range of 60 to 65%. So which you have already paid. So, you know, so you have already paid that on the first year premium. So if you surrender this plan now, then you know you're not getting the advantage of the lower cost over a period of time, because you know the way ULIPs work is that they charge upfront some money, but their assets under management or AUM fees is much lower. So what happens that if you are buying for a 20 years, once your corpus gets built up, at that 2% on the corpus that you pay to a mutual fund to manage your money becomes much lesser on a ULIP, because there the
it starts giving you returns after a period of time, after the charges.
Yeah, so because there the charges are in the range of about 1 to 1.25 or 1.35% at max. So you end up saving a substantial amount then. But then 10 years is not the term to buy a ULIP for. It's too small a term unless it's for a very, very specific purpose. So again, now you have paid for 5 years. I think next 5 years you're going to get an equivalent return, whether in a ULIP or if you're going to go for a mutual fund, because it depends on the return of the market. But be careful of the fund you're investing in. Even HDFC has multiple equity funds. See how they are performing, and switch to a fund which is in the top quartile of the performance. So go to their website or go to any website like ours and go and look at how the fund performance of the various funds that HDFC offers is doing, and select the right fund. The switches and ULIPs are free. So don't be shy of making the switches. On MetSmart, again, 10 years is a very short term. Again, you have paid most of your charges. Again, I would say that keep paying it for another 5 years. And after that, whenever you buy a ULIP, please be very clear. See, ULIPs need to be bought for two basic purposes. One, you're buying for your child and you want to build a corpus where the future investment will happen for child in case something happens to you. Or the second is if you are investing for family retirement. Like you and your wife have a goal that both of us are going to retire at 60, 65. So when you make a family retirement option, there also you need a waiver of premium. Something happens, then the money should get invested for the wife. It's not only she gets a lump sum and then she has nothing at the age of 60, 65 or 70 for the golden retirement or the golden years that you had planned for. So you need to have a very clear purpose of why you're buying a ULIP, and if you do that, you'll never go wrong. But if you have just bought a ULIP for the sake of ULIP, then you have to reevaluate. It may even make sense for switching into an instrument which meets your needs more.
All right, Dinesh, what I can sum up from what Sanjeev has said, stick around. I mean, you've bought this product not knowing what you're buying into, but you've already done 5 years. You've paid up most of the costs up front. So just stay put with it if you can afford to stay put with it. Gentlemen, thank you very much for joining me here today and for your expert advice to all of you. If you have a money question, write into us at money@ndtv.com. You can also follow us on Facebook and Twitter. We are in both these places, and there's a link on which you can watch part of the show in case you've missed any part of this show. The URL is flashing on your screen. I'll see you again next week, same time.